With Bitcoin on a tear and hitting a new record high, investors who plan to cash in need to get ready for the tax hit. If you bought or sold Bitcoin or any cryptocurrency this year, the IRS wants to know about it. If you've owned or used Bitcoin, you may owe taxes no matter how you acquired it or how you used it. The IRS now asks this right on the first page of the 1040 federal income tax form. At any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? Yes or no? And you'd better check the correct box on your return. Nathan Rigney from the Tax Institute at H&R Block tells me that if you know that you've engaged in a transaction, it's very important that you check the yes box, because if you don't and you know that you've engaged in this transaction involving cryptocurrency, it could be considered tax evasion, and there can be criminal consequences. Now, that's the worst case scenario. At the very least, you could be hit with hefty penalties and interest for failure to report income. So here are a few things that you need to know about how to figure out if you should be hitting that yes box on the return. Make sure that you understand that if you've had a sale, receipt, or transfer of cryptocurrency, even if it's for free, or if you've had an exchange for goods or services or other property, then the IRS wants to know about it. You need to check the yes box in that instance. And also make sure that you have some critical information. There are a couple of things that the IRS is going to want you to report. They want to know your cost basis, the holding period, as well as the fair market value. Now, the difficulty is trying to get this information, because you're not going to get a tax form necessarily from an exchange that's going to provide all this for you. So keeping good records is really, really key. And one of the key factors that you want to consider is that holding period, because that can have a big impact on your potential tax hit. Here's how the IRS considers that holding period. If you have held on to this for longer than 1 year, then it's considered long-term capital gains, and it's subject to capital gains tax. That can be up to 20%. But if the holding period is less than 1 year, then it's considered ordinary income, and the tax hit there could be as high as 37%.